Good morning, everybody. This is Sam Stovall, Chief Investment Strategist at CFRA, welcoming you to our quarterly webinar, where this quarter we will be posing the question, will the consumer again lead the way? We will be delivering our investment strategy and market outlook for this final quarter of 2019. Accompanying me today on today's call are Garrett Nelson, who is Senior Equity Analyst at CFRA, covering in particular the consumer discretionary and consumer staples sectors, and Todd Rosenbluth, Director of ETF and Mutual Fund Research here at CFRA. Our agenda today is to give you a little understanding of who is CFRA, what do we do, but then jump into the presentation itself. Will we see a return of optimism, and what is our fourth quarter investment outlook? Then we'll dive a little bit deeper, talking specifically about the consumer discretionary and consumer staples sectors. And then we will wrap things up with an understanding of the current ETF flows, and then talk more specifically about investment vehicles that are focused on the consumer staples sector. And then lastly, we will open it up, so whatever questions you might have, we will be happy to answer. So let me start by telling you a little bit about CFRA. Well, we are an independent equity research firm. Our mission is to provide our subscribers with global, independent, and actionable research, as well as analytics to help them make better investment and business decisions. Our clients are basically those spread all around the financial community, asset managers, hedge funds, pension funds, banks, online brokers, etc. And what we do is allow our services to be used to support multiple investment strategies, whether they be long only, long short, diversified portfolios, high and low turnover portfolios, etc. Basically, our sophisticated global clients use our analysis in a variety of ways. But if there's one word that describes who we are, it is independence, because research is all we do. CFRA does not manage money or make trades, even though many investment research providers claim to be free of conflicts, they are not. So with that very brief understanding of who CFRA is, let me start off by giving our outlook as to whether we could see a return. Certainly the last couple of trading days have looked fairly strong for the overall market. Looking at data ended on October 8th, what we found is that on a year-to-date basis, things were very good. We had 10 of 11 sectors in positive territory. Technology, real estate, utilities being the strongest performers, up nearly 20% or better, as compared with a sub-16% rise for the S&P Composite 1500. Also, whether you look to large, mid, or small cap stocks, they were all up, as well as global equities were up nearly 13% on a year-to-date basis. The only sector in negative territory was the energy group. Yet in the challenging sell-in May period, meaning going from April 30th through the end of October, in this case looking at October 8th, what we find is that only 4 of the 11 sectors were in positive territory, and information technology was barely so. It was the defensive sectors, consumer staples, real estate, utilities, that investors had gravitated toward, and we were in positive territory. But whether you look to large, mid, small cap firms, whether you look to global firms, basically many of them had taken it on the chin, at least since the year-to-date period through the end of April, when we recorded the third strongest 4-month entry to any year since World War II. So what are the headwinds? Well, the headwinds certainly have been concerns centering around the trade tensions between the U.S. and China that then broadened out into a currency war. We had concerns about the flattening and short-term inversion of the yield curve, implying, but certainly not guaranteeing, that an economic slowdown and possibly a recession was around the corner. We are seeing a slowdown in global economic growth projections, whether it's here in the U.S. or whether it's overseas. And at the same time, we are seeing a weakening of S&P 500 earnings growth estimates. Also, we have to remind ourselves that historically, in the 6 months after the Fed has started a new rate reduction cycle, the market has fallen 1/3 of the time. Even though the market is traditionally up about 14% 12 months later and has been up a majority of those observations, in the first 6 months, however, the market has been down 1/3 of the time. Also, we are in a seasonally weak period, with the third quarter traditionally being the weakest of the 4 quarters. And then lastly, investors continue to be concerned by the increasing threat of recession, whether you look to an inverted yield curve, whether you look to a slowdown in manufacturing data, both here and abroad. But if you look to history for some encouragement, I think what you would find is that since 1990, because that's as far back as S&P has sector level data, in the fourth quarter, while the S&P 500 gained 4.3%, almost twice as good as any of the best prior quarters, we also saw that every sector posted positive returns in that fourth quarter, with consumer discretionary and consumer staples among the best. If you also look to the average frequency with which these sectors or the market rose in price in the fourth quarter, you see that the S&P was up nearly 80% of the time, and sectors with the best performances, 83% of the time, were consumer discretionary and consumer staples, along with healthcare. So history basically gives us some encouragement that more times than not, the fourth quarter tends to be positive as investors start looking a year out rather than simply 1 quarter ahead. Also, you can take a look at some of the tailwinds that are working in our favor this year. First off, global monetary stimulus. The European Central Bank recently cut interest rates and reinitiated its bond buying program. The U.S. Federal Reserve has cut interest rates twice and is projected to cut the Fed funds rate by another 25 basis points later in this month. We're also seeing a resulting steepening of the yield curve, bringing us out of that inverted phase. Also encouraging is when you look at the stock market performance itself, investors are not retreating, they're rotating. They're sticking with stocks, but they're gravitating toward the small and mid-cap issues. They're focusing on the value over the growth stocks. So basically saying, I want to stick with stocks, I'm just going to look to where the greater opportunities lie. But a benefit is that we are actually seeing a broadening of advanced participation. And then lastly, history reminds us that November and December are among the strongest months as investors tend to get into a good feeling ahead of the holiday season and as they look toward the coming 12-month period. Also, if we take a look at economic projections, what we find is that our economists are not looking for a recession in the coming 12-month period. Globally, the world is expected to show a 3.4% gain in real GDP in 2020 as compared with a 3.1% estimated growth in 2019. The developed international economies likely to see a slight slowdown from 1.8% this year to 1.7% next year, whereas the emerging markets are expected to show an improvement to 4.6% from the 4.1%. Whether you look at the U.S. remaining fairly flat at its 2.3% growth expectations, or the euro area also flat at 1.1%, we also see China expected to see a slight slowdown from 6.1% to 5.9%, but we see some potential improvement in many of the emerging economies. So again, the implications, the data don't point to a recession around the corner. If we look at specific targets that CFRA analysts have, earnings are expected to be up 10.3% in 2020 from a very low base of a gain of only 0.7% this year. primarily because the bar was set so high in 2018 with a near 23% year-on-year increase. We're encouraged also that revenues are expected to be up nearly 6% next year versus the near 4.5% this year. As I mentioned, GDP growth is likely to be flat, but the consumer is expected to continue to spend, showing 2.7% growth next year versus 2.6% this year. Inflation is likely to remain under control. The Fed funds rate should continue to ease and therefore stimulate economic growth. We don't think that the 10-year note will be rising dramatically at all, and in fact could be very supportive of consumer-related activities. The exchange rate is expected to increase, however, which could make some international investments a little more challenging, but at least oil prices are likely to remain below the $60 per barrel area. Bringing that down to the earnings level, we expect to see, as I had mentioned, about 10.3% growth in earnings in 2020 here in the U.S., 10.3% in the developed international in 2020, and 14% earnings growth as we look to the emerging markets. So even though some areas are expected to see some softening of GDP growth, other areas expected to show an improvement, corporate profits are expected to post 10+% increases in the coming 12-month period. Diving a little bit deeper, looking at those sectors within the S&P 500, again, 2019 looks fairly anemic. Only 0.7% earnings growth for the S&P itself, but looking at similar gains for the consumer discretionary and consumer staples sectors. But into 2020, even though the 500 is expected to be up 10.3%, consumer discretionary is likely to rise by 13%, and consumer staples won't be too far behind the S&P 500 with an expected increase of 7.0%. And then lastly, from my perspective, there's always a bull market someplace. This is a snapshot of part of the sector scorecard that is found on Market Scope Advisor, or MSA as we call it, showing the performances for the sectors and the sub-industries within the S&P 1500 Composite Index. On the right-hand side, shaded in blue, we show price momentum as well as the aggregate CFRA stars rankings, or the buy, hold, and sell rankings for the underlying companies. I'm showing 4 sub-industries in consumer discretionary and 3 in consumer staples that have favorable 12-month momentum and favorable CFRA aggregate stars. So we find in consumer discretionary, auto retail, footwear, general merchandise stores and restaurants, and in staples, soft drinks, household products, and hypermarkets and supercenters. So with that, that actually tees up Garrett Nelson quite nicely so that he can then talk to you about his consumer sector overview.
Thank you,
Take
Sam.
it away, Garrett.
Thank you. The consumer has obviously been very strong recently, and that's really helped drive U.S. GDP growth for the last several quarters, because consumption accounts for about 70% of domestic GDP, and the U.S. is so dependent on consumption, so it's especially important for the U.S. economy. But we like the consumer staples sector slightly more than consumer discretionary right now for several reasons that I'll discuss, including market cycle timing, recent performance, and valuation. And while consumer confidence is still at elevated levels, in our view, it's starting to look top-heavy, and CEO confidence has really plummeted recently, which we think is more of a leading indicator, and one of the reasons we are a little more cautious on discretionary names at the moment. We think this has really turned into a stock picker's market, particularly in consumer discretionary, where we think investors have to be very careful about picking their spots and which names they're going to invest in, especially in the retail space. Next, I'll explain why we prefer hybrid retailers, or those who have invested and continue to invest very heavily in e-commerce growth initiatives. And then finally, I'll highlight a few of our top picks in both consumer staples and consumer discretionary. First, on consumer discretionary, this slide shows the market cap weighting of consumers' discretionary stocks in the S&P 1500 index. Consumer discretionary, by the way, is the fourth largest sector in the S&P 1500. It comprises about 10.5% of the S&P 1500, and it's trailing only IT, healthcare, and financials. As you can see from the pie chart here, Amazon is by far the largest company in this sector, comprising almost a third of the total market cap. And if you add the other four companies broken out on this pie chart, those five companies account for 56% of the total market cap of consumer discretionary. So it's a very broad and diverse group of industries in this sector. This slide shows a profit pool map of consumer discretionary, and it shows all the different industries within the sector and their share of the sector's total revenue at the bottom on the x-axis, and the average EBIT margins of each industry on the y-axis on the left side. There are a few things I wish to point out here. First, specialty retail is the largest industry from a revenue perspective. Secondly, hotels, restaurants, and leisure has been the highest margin industry by far over the last 12 months. And the third thing is the lowest margin industry is automobiles, which also happens to be the industry that I directly cover within this consumer discretionary. Now moving on to consumer staples. Consumer staples accounts for about 7.2% of the S&P 1500. And the majority of the sector's market cap is also concentrated among just 5 companies. As you can see, Walmart is the largest company, followed by Procter & Gamble, the 2 beverage giants, and then Philip Morris. And there's been a lot of talk recently about how stock market leadership has really come from both consumer staples and consumer discretionary in 2019. A few weeks ago, for example, I heard Jim Cramer describe the current market as a PepsiCo market. But I think it's important to highlight that these two sectors have only outperformed the S&P by a little bit so far this year. As Sam showed, consumer staples are up about 20%, consumer discretionary is up 19%, and the S&P 1500 is up about 16%. So they really haven't been market leaders to the same extent as IT, for example. Looking at this profit pool map of consumer staples, you'll see that food staples retailing is by far the largest industry from a revenue perspective in the sector, but it's also by far the lowest margin industry. And that's because grocery stores are included in that industry. And grocery stores are, of course, a notoriously low-margin business. The other thing I would note is that the highest margin industry is tobacco, followed by beverages. This next chart shows the performance of both sectors relative to the S&P 1500 over the past decade. And as you can see, consumer discretionary has outperformed by a wide margin over the past 10 years. While the consumer staples sector has underperformed the broader market, particularly over the last 3 years. Before that divergence, consumer staples and the broader market were tracking each other very closely until 2017. But the fact we've been in the longest bull market ever, and given this relative outperformance of discretionary versus staples in the broader market, makes us a little more cautious towards discretionary at the moment. Next, moving on to valuation. Consumer discretionary is also trading at an unusually large premium to the S&P at the moment. And while the consumer staples sector has benefited from multiple expansion over the last 3 or 4 quarters, it's currently trading at only a slight premium to the S&P 1500. Next, let's look at consumer confidence, which has been at very elevated levels for several quarters now. In September, many of you probably saw that consumer confidence just posted its second largest monthly drop in 8 years. But more concerning from our view is that CEO confidence also is at its lowest level in 10.5 years. 2/3 of CEOs said they expect U.S. economic conditions to worsen over the next 6 months, which we think could portend a pullback in CapEx. And CEO confidence historically tends to be a leading indicator relative to consumer confidence. So this is just another reason why we're a little more cautious on discretionary at the moment. This slide really underscores the importance of stock selection within consumer discretionary, because a lot of brick and mortar retailers are struggling despite the strength of the consumer recently. As you'll see, there's been a sharp increase in store closures since 2016. And so far this year, there have been over 5,000 more stores that have closed than opened in the U.S. That brings us to our next slide. This chart shows U.S. retail sales growth going back to 2000, which is the red line, as well as e-commerce sales growth on the green line. The blue line shows the percentage of all retail sales that come from e-commerce, and that corresponds to the values on the right axis. As you can see, since 2000, e-commerce has grown from less than 1% of all U.S. retail sales to close to 11%. Also, I would point out that during the Great Recession, 2008, 2009, both U.S. retail sales and e-commerce sales growth turned negative, but e-commerce continued to take market share from brick and mortar during that time period. I would also point out that U.S. e-commerce sales grew at over 4 times the overall retail growth rate last quarter. So e-commerce sales growth was 13.3% versus overall retail sales growth was only 3.2%. And we think this is a major long-term secular growth trend which will continue for many years into the future. And we recommend that investors have exposure to this trend. So we just saw on the last slide how e-commerce sales are growing at 4 times the rate of total retail sales in the U.S. This slide here shows the e-commerce sales growth and the overall same-store sales growth of various large-cap retailers, mainly in the food and staples retailing sector or industry. They've all invested very heavily in e-commerce growth in recent years. And a few of these companies are growing their e-commerce sales at over 10 times the growth rate of their overall same-store sales. And they're posting growth rates that are stronger than Amazon's recent growth rates, but off a much lower base, of course. In both consumer discretionary and consumer staples, we prefer the equities of companies such as we were showing on the last slide, who have been investing very heavily in e-commerce. And we argue these companies will benefit from both stronger top and bottom line growth and multiple expansion relative to peers. And our 2 favorite names right now on this theme are Walmart within consumer staples and CarMax within consumer discretionary. Just looking at Walmart, they're really starting to reap the benefit of very heavy e-commerce investment over the last several years. Groceries are really Walmart's bread and butter business. It accounts for a majority of their revenue, and they're far and away the largest grocer in the U.S. In fact, if you take Walmart's total annual revenue, it's greater than the number 2 through 25 ranked grocers in the U.S. combined. That's how large they are in grocery. And we think they have significant advantages over Amazon, not necessarily when it comes to general merchandise, but certainly when it comes to grocery. They have over 10 times the number of stores as Amazon has right now with Whole Foods, and they also have a much larger selection of items at lower prices. Also, Walmart has the refrigeration capacity, which we think is very important for grocery, and the fact that over 90% of the U.S. population lives within 10 miles of a Walmart provides a very important strategic advantage, we think, relative to Amazon. The chart at the bottom of the slide shows how about 4 or 5 years ago, Walmart really started investing heavily in e-commerce. And e-commerce as a percentage of their total CapEx went from less than 20% of their total CapEx to over 50% in the most recent fiscal year. They spent over $5 billion in fiscal 2019 on e-commerce, which is pretty amazing. Next, we'll move on to CarMax. We have a strong buy opinion on this name. They're the largest auto retailer in the U.S. They sell all used vehicles, but they are in the process of rolling out their online car buying experience nationwide, which we're very bullish on because it's proven to be extremely successful in the test markets where they've introduced online car buying, and they expect to have this capability available to the majority of their customers by March. With very minimal CapEx, I would add. Their CapEx is only going to be about $40 million higher in order to implement this online car buying experience. Also, used cars continue to take share of the overall U.S. auto market. Over 70% of all vehicles sold last year were used vehicles. Younger buyers continue to show a preference for used vehicles relative to new vehicles, being more price conscious. And there's also a growing gap in average monthly payments right now between new vehicles and used vehicles. So the average difference in the average monthly payment is about $158 right now. That's up from just $112 5 years ago. So we're very bullish on CarMax. We like their outlook over the next 12 months. And then just touching on a few of our other top picks within consumer staples and consumer discretionary. I won't go into too much detail about why we like the other equities here. I already discussed Walmart and CarMax, but we also like PepsiCo and Coca-Cola and consumer staples, both of which we think are well positioned to deliver solid high single-digit to low double-digit earnings growth over the next 2 to 3 years, driven by strong organic sales, and both of which are dividend aristocrats, of course, and very high-quality blue-chip names in our view. And then in consumer discretionary, as I mentioned, my direct area of coverage is autos. So here are a couple of other of my top picks in that industry. O'Reilly and AutoZone are two of the largest auto aftermarket retailers. And we consider both of those companies to be high-quality names that generate gross margins north of 50%, and they're both being supported by a very strong secular trend in terms of the average vehicle age in the U.S., which is currently at a record high. So the average U.S. vehicle age right now is 11.7 years, and that's up from 9.7 years 10 years ago. And that's creating very strong demand for auto parts. Auto repair shops are doing very well right now as a result. And also, both of these companies have a long history of returning cash to shareholders via buybacks. In fact, O'Reilly has repurchased nearly half of its total outstanding share count since beginning its buyback program in 2010. And AutoZone, amazingly, has bought back 85% of their total share count since beginning their buyback program way back in 1998. Both of these names are also fairly recession resistant. If you look back to the Great Recession, the period from mid-2008 to mid-2010, O'Reilly shares actually rose 107% during that time period. AutoZone stock was up 59%, and during those 2 years, the S&P fell 20%. So we really like these stocks. They tend to perform very well late in the cycle and during downturns. And with that, I'll turn it over to Todd. Thanks a lot for your interest and your attention.
Thanks, Garrett. Good to follow you and good to follow Sam. For those that don't know, this is Todd Rosenbluth. I head up the ETF and mutual fund research effort. There's now $4 trillion invested in U.S. listed ETFs. We've seen $200 billion of net inflows through the first 3 quarters of the year. I'm going to walk you through a bit of where the money's gone from a sector perspective, talk about some sector-oriented ETFs, and then touch on how you can play a more defensive slant towards discretionary and consumer staples. So I show this slide or a version of this slide on a quarterly basis. I find it's a good way of getting a sense of where the money's going. From a sector standpoint, sector ETFs are increasingly being used as a complement or replacement for individual stocks. You can see the third quarter consumer staples was one of the bright spots. The defensive sectors that Sam talked about during that seasonally weak period, the stocks did well. Not surprisingly, investor interest in consumer staples in real estate and utilities were very strong, whereas we saw outflows in financials and in healthcare. In the case of healthcare, that was a continuation of the trend we saw in the second quarter, whereas consumer discretionary went from net inflows in the second quarter to net outflows, slight net outflows in the third quarter. But as we look historically, over the past year and a half, we've seen much more consistency in the net demand and interest in consumer staples-oriented ETFs. That's the red line that's towards the top half of the chart. It's been positive for all of the quarters and in many cases quite strong, whereas consumer discretionary is much more volatile in terms of investor interest. That has to do in part with the stocks being more volatile as well. But you can see significant peaks and significant valleys. This is, of course, not a leading indicator. It doesn't necessarily mean that we'll see the the current fourth quarter of 2019 to recover. But what we have seen historically is the fourth quarter is a very popular one for ETF usage. The last 2 fourth quarters for the broader industry, not for sector-oriented ETFs, we saw $100 billion plus of net inflows. And if we did that, then we'd probably match the overall $300 billion plus of net inflows for the broader industry. Let's talk a bit about the way that CFRA covers ETFs. If you're not familiar, we use the great holdings-based coverage of individual stocks from Garrett and our broader research team to do valuation and risk assessment. That helps us to be much more forward-looking than our competition that's out there. It helps us to understand what is inside that can drive future performance rather than looking backward. Deep team of analysts that are there that are helping us, as mentioned, on a valuation and risk perspective. And then what we've done for years and we continue to do is include cost as part of our research. So cheaper funds tend to maintain their performance success, whereas more expensive funds or those that don't trade as frequently can drag down returns. And that helps to set the stage for where we're going in terms of just laying out some individual ETFs that we cover and have interest for you. So sticking with the sector side of things, consumer staples, the Consumer Staples Select Sector Spider XLP, that is tied to the S&P 500 sector that Sam talked about historically, and from an earnings perspective that Garrett talked about more in depth at where are the constituents. But this is done with more of a awareness of the market capitalization of the individual companies, which then rolls up to the various sub-industries. You can see household products, soft drinks, packaged foods are the 3 largest of those sub-industries. Consumer staples is among the more concentrated of the sectors. The top 10 holdings are 70% of the portfolio. We, and Garrett and our broader consumer staples research team, has a strong buy or buy recommendation on 5 of those 10. Garrett talked about Walmart and Coca-Cola and Pepsi, but Procter & Gamble and Philip Morris International are the 2 others that we have strong buy recommendations on. You contrast that with the other ETF on the slide here, which is the ticker RHS. It's an Invesco equally weighted product, as its name suggests. All of the stocks are of equal size when rebalanced on a quarterly basis. There's a bit of a drift that's going to lead to more diversification, or certainly at the security level, where the top 10 holdings are just a third of the portfolio, but also disparity at the industry and sub-industry level. So, for example, packaged food and meats is more than a third of the portfolio. It's a significantly higher weighting here than in XLP, and that's in part because companies like Tyson Foods and Kellogg are a more sizable weighting within the portfolio. I would note that RHS comes at a premium fee. It's a higher fee than what you'd get with XLP. So that's just the sector landscape, or a touch on that sector landscape. On the next slide here, I want to just talk about various smart beta strategies and the popularity that they've had in recent quarters. So as a reminder, we and others in the industry consider smart beta to be anything that's not market cap weighted. So the S&P 500 based products, like the iShares S&P 500 would be market cap weighted. We'll give you examples in a moment about some ETFs that we would put within that realm, but you probably can get a sense of that by looking at the popularity of dividends and low volatility. In the third quarter of this year, highly popular as investors looked to reduce their risk profile in August and then get some capital appreciation in September. Value was also in favor for the first time in a while during the third quarter, where the trend really picked up. And as we move here to the next slide, I want to just walk you through the differences between two of the more popular lower volatility ETFs, SPLV and USMV. So SPLV is the Invesco product tied to the S&P 500 index. It's the 100 least volatile stocks within the S&P 500, rebalanced and reconstituted on a quarterly basis. There are no sector constraints, so you'll see some of the more traditional sectors like utilities and real estate and being relatively high versus the broader market. Consumer staples is modest, but not that much higher, where you won't see the same exposure to technology or consumer discretionary, more risk-on sectors. We touched on Pepsi and Walmart again, so I want to just highlight that Hershey and Mondelez are examples of stocks within the sectors that Garrett talked about that you'd find within SPLV. In contrast, USMV from iShares is a larger ETF. It's actually been the most popular ETF in 2019. The greatest inflows have gone into this. It's very rare for a smart beta-oriented ETF to outgather products that are cheaper and that are more broadly diversified. But you can see here at the next bullet that we'll come back to the slide. Sorry about that. You can see here on that bullet, information technology and consumer discretionary are among the larger industry or sectors that you'd get exposure to, in addition to consumer staples. And companies like McDonald's and Yum Brands are represented within this portfolio. Now let's move to the next slide. Apologies again for that. To just give you a reminder of the way that we at CFRA are covering ETFs and the reports that are available to you. As Sam mentioned, all of the research that the three of us have can be found either on MarketScope Advisor or in the feed. The right-hand side is a screenshot of one of our ETF reports where there'll be green and yellow and red telling you what is contributing favorably or neutral or unfavorably to the overall rating. We have coverage of 1,500 plus ETFs. On the left-hand side is a copy of thematic research. What I publish is called Funds in Focus. Sam has separate thematic commentary that gets published on the MarketScope Advisor, and then Garrett, as part of the equity research team, rotates through. This is a piece we wrote about the zero commission ETF trend that's been popping up and the impact we think it can have on the overall industry. If you have not received what you're seeing on this upcoming slide, our weekly newsletter, I'd encourage you in the question and answer box that you can see on the platform, in addition to submitting questions so that we can cover the topics that you have interest in, you can let us know you have interest in this. The most popular articles that get published on a weekly basis, the next week we send a newsletter with alerts and links so that you can be able to more easily find content that some of your peers have found most interesting. We'd encourage you to take a look at it. Sam and I frequently have content that's in here, and Garrett again on a rotating basis. And then lastly, I want to just promote the upcoming webinar that I'm doing next week with a couple of my colleagues. You may have known that CFRA made an acquisition in August of a company that's an ETF data and analytics firm, FirstBridge. We're really excited about that and the great tools and resources that it helps us provide new information for you as our clients. This webinar is going to go over some of the groundbreaking research that we think we put forward in the industry, looking back over the last 5 years at where the money has gone and hasn't gone, who the firm winners and losers are. And we're going to be joined by Kathy Seifert, who's a colleague of ours that covers the asset management companies from an equity research perspective. With that, we'll move us forward to the next slide. And Sam, I think we've got some questions that have already come in.
Good. Well, thank you, Todd. Thank you, Garrett, for your research, your commentary, etc. And yes, we'll be getting some questions as they float in. In the meantime, let me ask a couple of questions that came to my mind. Todd, you were just on, so let's stick with you. You were talking about the minimum volatility ETF getting the greatest inflows, but you also recently wrote a report regarding dividend ETFs and how popular they were in the third quarter. Tell us a little bit about that report and give us some examples, if you will.
Yeah, happy to do so. So on a prior slide, I showed that roughly $4.5 billion of money went into dividend-focused oriented ETFs. In the piece that you're referencing, which you can find, our clients can find on MarketScope Advisor, either under the thematic research part of it or the ETF tab of it, I looked at dividend growth-oriented ETFs. In particular, NOBL, which is the ProShares S&P 500 Dividend Aristocrats. Garrett mentioned about Coke and Pepsi being examples of that. And the sector exposure, these are companies that have raised their dividend 25 plus years. We continue to see dividend increases among those companies that are a part of the Aristocrat program. The Spider S&P Dividend, which is SDY, was the second ETF that I highlighted on there. That's a more broad market cap orientation. So the S&P 1500 companies that have raised a dividend for 20 plus years. So there's some overlap there, but there's also a bit more of a growth tilt because you have small and mid cap companies as well as companies that hadn't yet hit the 25-year mark but hit the 20-year mark. And then lastly, I highlighted an ETF. The ticker is LEAD. LEAD is the ticker. Smaller ETF that's focused on looking for companies that will be raising the dividend using more forward-looking analysis. So there's a lot of great dividend ETFs that are out there. Those are just 3 examples, and I encourage listeners to take a look at that research report we published.
Okay. Well, let me stick with you. One more question, Todd. You were mentioning how surprising it is that we have good flows from the minimum volatility, so investors obviously are nervous. Is it also surprising that there have been significant inflows into bond ETFs rather than equity funds this year, especially with interest rates being as low as they are?
That's certainly the case. So we are seeing a record year for fixed income ETFs. It's about $113 billion of money that has flowed in to fixed income ETFs. That's higher than what we've seen for equity ETFs. Part of that is the volatility that's happening in the broader markets, a flight to quality. We actually separately wrote a piece that published today looking at the growing demand by insurance companies in using fixed income ETFs to manage their overall accounts. And we're starting to see that trend, a very small part of the ETF pie. But if it continues, it will be the trend being fixed income outgathering equity ETFs. It would be the first time in 10 years since we've seen that happen. And the current environment is quite different than the great financial crisis that we touched on earlier. We are having a close to 20% equity market. So even though investors are nervous, they're still making money in the equity market. So it is intriguing to see fixed income ETFs so popular. I'll just add that we have research and ratings on over 200 fixed income ETFs on the platform, from the low risk products like SHY, which is a very ultra short term treasury product, to products like HYG, which is a high yield bond ETF. Both of those happen to be offered by iShares.
Okay, good. Garrett, now a couple of questions for you. You provided a well-reasoned argument for why you prefer the consumer staples sector in this environment, but can you also provide us with a few other recommendations in consumer discretionary if we do end up having a more bullish macro outlook on consumer fundamentals and market performance over the next 12 months?
Sure, Sam. As I mentioned, in consumer discretionary, my direct coverage consists of the auto names. But I would look at some of the higher beta risk on sub-industries within auto, such as auto suppliers, the auto parts and equipment companies. Two names that we like in that sub-industry are Tenneco, ticker TEN, and Dana Incorporated, ticker DAN. And both of those companies specialize in driveline and ride performance products. And the valuations, they're trading at very inexpensive multiples here, and we think they'll perform well in a more risk-on type environment where consumer discretionary outperforms. And they've also been hit very hard. That whole sub-industry of the auto suppliers has been hit very hard this year with all the tariff talk and amidst a very deep downturn in the auto market in China. China accounts for close to 30% of global auto demand, and their auto sales are down 10% so far this year. And the auto suppliers have been hit particularly hard. So we would look at that space, and those two names in particular we like in a more bullish, broader market environment.
Okay. You did mention about consumer staples and how you like them. How do you see the grocery e-commerce wars playing out in the coming years? And do you see Amazon fitting into the landscape versus Walmart, Costco, Kroger, and others?
So Amazon is still the largest grocer in e-commerce. They have about 30% market share of the U.S. grocery e-commerce market right now. They bought Whole Foods a little over 2 years ago. They paid close to $14 billion. And I think a lot of investors thought that they would be farther along in growing that business by now, but they've really struggled. And I think a lot of it has to do with prices. They've announced 3 separate rounds of grocery price cuts, but yet their prices are still significantly higher than both Walmart and Kroger, the number 1 and 2 ranked grocers overall. And also you've had the rise of these deep discount grocers such as Aldi and Lidl, which we think is hurting them. And you know, Amazon, it seems their grocery strategy has really been to use it to expand the Prime Now delivery service, and also they're focusing on growing in metropolitan areas. So they're not looking at growing all across the United States. They're really focusing on larger metropolitan areas. But looking back, they've hardly grown their overall store count at all since the Whole Foods acquisitions, and their same-store sales have been fairly stagnant. They also have this very fast-growing, much higher margin business in terms of AWS, the cloud computing business. So we think going forward, they're going to choose to allocate their growth capital more towards that business than throwing a lot of capital at the very low margin dilutive grocery delivery business. Okay,
thank you. Well, now for equal time, I guess it's time that I put my own feet to the fire. Question being raised: seasonality did not work in 2018. Why do you think it might this year? So as you recall, one of the slides that I showed was that in the fourth quarter since 1990, the market gained in price almost 80% of the time, with each of the sectors posting positive returns. Obviously, last year in December in particular, we were crushed and on a closing basis just missed a bear market by less than 1 full percentage point. So why couldn't the same thing happen this year? Well, I think one primary reason is that we have a totally reversed monetary policy being embraced not only here in the U.S. but overseas as well. In the last month, we had 8 central banks having meetings, with a majority of them beginning a rate reduction cycle. As I mentioned, the ECB lowered rates for the first time in a while and started rebuying their bonds. Last year, I think the reason that the U.S. market declined as sharply as it did is because investors were worried that the Fed was going to be raising rates one more time, that they then did do in latter part of December, dropping us more than 19% through December 24th. Well, we've had 2 rate decreases so far this year. We're expected to have another one, and earnings forecasts are expected to be up more than 10% next year, whereas earnings forecasts were half of that by the latter part of 2018. So this year is not last year, and so that's why we could end up seeing a positive December. Now, another question is, well, what about overseas? Leading indicators in Germany, Japan, and the UK are deeply negative, and the leading economic indicators is relatively stagnant here in the US. Do you think we still have momentum for stocks in the year ahead? I think so, because I like to say that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. Looking, as I showed you with the GDP forecasts for all of 2020, none of the marketplaces is expected to show a recessionary kind of growth or contraction, I should say. Also, if you look at some other ancillary indicators, every recession since 1960 was preceded by a double-digit decline in housing starts. Yet the most recent reading on housing starts was for a gain of about 6%. Along with that, the reason housing starts is so important is because consumer confidence is so important, as Garrett showed us. And what we're finding is consumer confidence remains elevated, even though it's a little softer than it might have been at a recent peak. It is still elevated and not in the zone of concern that we traditionally see. Also, what we find is that we have had to have been in an inverted yield curve environment for an average of 11 months prior to the U.S. falling into recession. So, yes, I think that all economies are tethered together like mountain climbers. Even though the U.S. has a solid grip and firm footing, if the other economies slip and fall, they will probably drag us down with them. At the same time, I think that since we would be landing on them, it might be a little softer contraction for us than for other countries. But right now, because the U.S. is such a service-oriented economy, about 90% of our GDP is service-related versus about 10% for manufacturing, our belief is that we'll probably see a flat to, at a worst-case scenario, a softer 2020, but each of the quarters from Q4 of 19 through Q4 of 20 are expected to show increases of more than 2% for GDP. And so that's why, yes, we have to worry about what's going on overseas, but we're still of the mindset that stocks have the ability to grind their way higher over the coming year. And then one last thought from my question for myself is, what is our 12-month target? We have a 12-month target for the S&P 500 of 3,200, which is about a 7% price appreciation from where we are right now. That's not a full year 2020. It's a rolling 12-month price target. We come up with that based on 2 inputs. One is, what is the market cap weighted price target differential for each of the stocks in the S&P 500, followed by CFRA equity analysts. Combined with that is something called the Rule of 20. If you go back to 1948, looking at inflation and looking at GAAP earnings, or you go back to 1988, again looking at inflation or looking at operating earnings, PE plus inflation has averaged 20. Not a surprise that we therefore call it the Rule of 20. So a very simple formula is 20 minus the year-on-year change in core CPI. So 20 minus CPI times earnings. What is the full year earnings integer for the S&P 500? And then that comes up with a good guesstimate as to what fair value is 12 months from now. So we put those 2 together to come up with our 12-month target, which is, in a sense, offers our analysts the ability to say, okay, if I like an individual stock, then its target price potential has to be greater than the market to give it a 4 or a 5 star. but has to be less than the market if we give it a 2 or a 1 star. So that's how we come up with the 3,200 target for the S&P, which is bullish, but not overly so. So it sounds as if we are running out of questions. We are also running out of time. So with that, I will say thank you to everybody for participating. Thank you, Garrett, for your thoughts on both consumer discretionary and staples areas. Thank you, Todd, for your thoughts on dividend aristocrats, low volatility, consumer staples ETFs, and the think pieces that you provide on a multiple time basis. You put me to shame with the number of reports that you put up on MarketScope Advisor. So please take advantage of his and our thematic research. So with that, thanks everybody. We will have a replay about a week from now, and we will be making those details available to you shortly.